forget to start it. Okay, so I've started the recording. So as I was saying, what we did last week, and the recording is available, so just go and have a look for it, the recording from the 18th of September. It is posted in your announcements, the link to that. So we started last week working through mock, I'll call it task 2, mock task 2, so that we are working through an entire assessment that will cover all of the learning units that you guys have to do for task 2. So also just to remind you that task 2, so you remember, is on learning units 3, 4, and 5. Ah, there's Diana. Hi, Diana. Nice to see you joining us as well. I was just beginning to despair that it was only going to be me and Melanie tonight. Oh, and there comes our Mita as well. She's usually online.
Good evening.
Okay. Hi. So remind you guys, 3 learning units, 3, 4, and 5. So risk and return, interest rates, bond valuation, and share valuations. So again, I'll just remind you guys, the best thing to do is to, in preparation for the task, is to actually go through those 3 learning units as if you were studying for a closed book test. Because you guys have to work quite quickly through the information on the day of the task, and you don't have time to then go through examples and try and work out how things work and where the formulas, etc. So please learn the learning units as if it was a closed book test, so that on the day of the task you're already familiar with everything, and then things will go much more smoothly and you'll be able to locate everything that you need. You'll know where it is in the textbook, and you'll be able to cover everything in a much better manner. And also, more importantly, you're then also starting to prepare for the exams, because the exam will be on all 7 learning units. So if you start actually studying your learning units now for the task, that means it's going to be that much easier when you start doing your exam revision. An exam is closed book, so we have to start preparing, start thinking about that. So also, as I did last week when I went through the questions, I also used the formula sheet to indicate to you guys where in the formula sheet you needed to look for the specific question we were working through, because again, that's very important. In the exam, you're going to have only the formula sheet attached to your question paper, and you need to be familiar with working with that formula sheet, because it's all you'll have with you, and you must know what it looks like, what information is on there, and also, more importantly, what information is not on the formula sheet, so that you're fully prepared to work with it in the exam as well. That's actually quite a key aspect. Okay, so I don't see anybody else joining, so I'm going to share my screen now, and then we'll continue. So last week we started at question 1, and I got from question 1 to question 2.1. So that will be on last week's recording. And then this week we'll do question 2.2 to the end. And this is mock task 2, and this is taken from a 2020 paper. Okay, just go here to share my screen. Okay, there we go, sharing my screen. So I'm going to go over to the question paper. So we're starting with question 2.2. Excuse me, and this is a learning unit 4 question. from your interest rates and bond valuation chapter. So always, and I'm going to keep coaching you like this through all of the questions, because I really am, my focus is to start coaching you for the exams at this stage. So you are thinking along those lines. So when you look at your question and you see how many marks the question is for, so this question is 6 marks, that means it should take you, in a closed book situation, no longer than 6 minutes to complete this answer. So please keep that in mind as you are working, because that is what you're going to have to, the pace at which you're going to have to work when you are writing the exams. So here we've got our client, Mr. Stokes, has approached us for advice as to whether he should purchase bonds. So remember, I've also told you, work with a highlighter always. So we immediately highlight that, and we know that this question is then going to be related to LU4, bond valuation. In a company called Renew Limited, who is on a major expansion drive, and they urgently require additional financing for their project. So obviously this company is selling new bonds in their company because they are trying to raise funds. So the bond they are offering has got the following characteristics to it. So this is the information that we are given. So I have already made some notes. These notes in blue and obviously the highlights in green are notes that I have made on the question paper to assist you. This is what I want you to write on your question paper when you are sitting there reading it and working with the question paper, because you need to know this and be able to identify this so that you can then take this information, put it into your formula, and quickly come up with the correct answer within 6 minutes. So the information that they've given us about this bond that Renew Limited is selling is that it has got a par value of 50,000 Rand. The price today, in other words, if we were to purchase this bond today, the price is at a discount of 5%. The coupon percentage, in other words, the annual payment that we will receive if we purchase this bond, is 14% per annum. The bond is going to mature in 20 years' time, and our interest, in other words, our 14% per annum interest that we get paid, is going to be paid to us quarterly. So now we need to break that down. If we were going to use financial calculator version of the answer, we then need to identify each of these variables with one of the variables on our financial calculator. So the par value of the bond, the 50,000, that is the amount that we will receive in 20 years' time when the bond matures. So that par value we treat as the future value of the bond. If you are using the formula for bond valuation, then in the formula, this would be M in the formula. Let me just quickly show you the bond valuation. So this is your formula sheet. Here is the bond valuation formula here. So you would come to your formula sheet, you would write the formula down on your answer paper, and then you would go and fill in each of the variables that you have been given the amount for. PMT, R, N, M. Sometimes they give you B0, and you've got to work out one of the others. So you need to be able to identify either using the variables in the formula or using the variables if we are using the financial calculator. So the par value is future value if we're using the financial calculator, and it is M in our formula, M over there in the formula if we are going to use the formula to calculate our answer. And remember, guys, you can, if they don't specify in the question that you must use the formula or use the financial calculator version, you can use either one, so whichever one you prefer. Your textbooks have got both versions in all of the questions. Then they telling us that the price today, so in other words, if we were to purchase this bond today, how much would we pay? So today we know at time 0, which is today, that is then the present value of the bond. In terms of our formula, B0 is the bond valuation today. So that's actually what the bond valuation formula calculates. What is the valuation, theoretical value of a bond if we were to purchase it today, given the fact that its PMT is XYZ, etc. Okay. So the bond valuation B0 means at time 0, which means today, which means present value. Then the coupon payment, so this is if we owned this bond, the bond would pay us interest annually while we owned it, because this is the way that the company Renew Limited compensates us for the fact that we have given them whatever the amount of money is that we've paid them to purchase the bond, which is the so-called loan that we make into the company. And for the use of our money, they will pay us 14% per annum. So the important thing to remember with the coupon percentage is that this 14% per annum is always calculated on the par value. On the par value of the bond. Please remember that. 14% of the par value, because that amount of the PMT or the coupon percentage that we receive does not change. So over the full 20 years, that interest rand value that we receive into our bank account will be identical every single year. Okay, that's important. So 14% is fixed and the par value of 50,000 is fixed. So 14% of the 50,000 is how we calculate the rand value that we will be paid, which is what we call the PMT if we are using our financial calculator. And also in the bond valuation formula, PMT is, we also use the variable PMT for that, those annual payments that we receive. Then they are telling us that the bond matures in 20 years' time. So that will be our value for N. Number of years, N is the number of years, 20. And then they tell us that interest is paid quarterly. So remember the number of times that interest compounds per annum is equal to M. So if interest compounds quarterly, it means that interest will compound 4 times a year. So therefore, M will be equal to 4. N will be equal to 20. M will be equal to 4. PMT will be 14% times 50,000. And then what about this present value? How much are we actually going to be paying Renew for the bond today? They said a discount of 5%. So that means a discount on the par value. So 50,000 minus 5% or 95% of 50,000 is the price we will actually pay them today. So they've said it here, advise Mr. Stokes whether he should purchase the bond, knowing from our dealings with Mr. Stokes that he has got a required rate of return of 13.5% for his investments. So in other words, Mr. Stokes doesn't want to purchase any investment that is going to give him a return of less than 13.5%, because otherwise that won't meet his requirements. So what is the missing variable? We've got future value, present value, we've got PMT, we've got N, and we've got M. So if we go and have a look at the formula sheet here, we've got the present value, BO. We know what PMT is. R, we don't know what R is. We do know what N is. We do know what M is. There's R again. That's the missing variable R, and we know what N is. So we can therefore see that we are going to have to solve for R in the formula. We don't know what that rate of that percentage is that we need to use to discount these present values in order to arrive at that present value that they have given us. So at the bottom here, R is then, what is the value for R? That is what we've got to solve. In other words, in your textbook, they also call that the yield to maturity. So the percentage return that I will earn if I purchase this bond today at a purchase price of 5% discount to its par value, and all of these other things are true. Okay, so we are solving for R. So if we go and have a look over here, this is the memo. This is how you should write it down on your answer book. The variable and then the rand value identified with that. So the future value of the bond is 50,000. N is going to be, and now remember, as soon as there are multiple compounding periods in a year, if this interest here was only going to be paid once per annum, then M would be equal to 1. M for Mary would be equal to 1. Because we are going to receive our interest 4 times a year, M for Mary is equal to 4. So we then need to, in calculating the value for N in our formula, we need to use N times M. So our formula is actually always N times M and R divided by M. But when M is 1, N times 1 is going to be whatever the value for N is. So just get into the habit of always just knowing, if I want to calculate the value for N or the value for R, I must always use N times M and R divided by M. So N, which is number of years to maturity, is 20 years, and M is 4 because interest is going to compound 4 times a year. So the value for N that we're going to type into our financial calculator is 80, 20 times 4. Then PMT, 50,000 is the par value of the bond times 14% coupon rate. But again, because that 50,000 times 14% would give us the total annual interest, we've got to divide that by 4 because the interest is going to be paid to us in 4 installments over the year and not all in one lump sum. So PMT is going to be 50,000 times 14% divided by 4. So divided by the value for M. So each of those 4 payments that we get throughout the year will be 1,750 Rand. Then the present value, in other words, how much are we going to be paying them for the bond at time 0 today? 95% of the par value because we're getting a 5% discount. So we will be paying 47,500 to purchase the bond. And remember, in your financial calculator, wherever you have got a present value, we always enter that as a negative amount in our financial calculator. And that's purely just a financial calculator quirk that we have to do that. Future values are positive and present values, we put a minus in front of them. And then it is going to be comp I. So this is on our financial calculator, comp I or IYR, depending on what's typed, on what that key on your financial calculator says. Some say I and some say I/YR. So have a look at this again. When we press comp I, we are going to get an answer of 3.7. So that means we have calculated our return on this bond is going to be 3.7%. but that is going to be for each of those 4 payments, because we are calculating, we've multiplied n by 4. So we said in total we will receive 80 interest payments. Each one of those payments will be 1,750 Rand. So given that fact, R is going to be 3.7, but that's for each one of those individual payments. So we must then multiply that by 4 to convert that to an annual return, 14.8% per annum. So it's 3.7% return for each of those individual payments multiplied by 4 gives us 14.8% per annum. Then we're going to compare that to the 13.5% return, required return of Mr. whatever his name was. So we can then say, yes, he should purchase this bond because the bond is going to give him a return of 14.8%, which is higher than the 13.5% that he is wanting as a minimum return. So please don't forget to give the conclusion, because out of the 6 marks, that's one of the marks there for giving them the advice, should he purchase the bond or not, because that is actually what they asked us. So I have also just put a little note over here with this answer. Don't forget, because R, the nominal rate, the nominal rate of the return that we want for R, because we have basically used R divided by M, this 3.7 is R divided by M. In other words, it's 1/4 of the annual percentage. So therefore, we must multiply that. We must say R times M to get back to the annual nominal rate. So this is a really nice question to practice with because it has got multiple compounding periods in it. So it gets us to practice our N times M and our R divided by M parts in that question. And remember, all of that you need to be able to do in 6 minutes. If you were using the formula, you're going to battle a bit with this particular formula to solve for R, because R appears in 2 separate parts in your formula. But if you have a look at the memo, all of the marks are correctly identifying the variable and placing the correct value next to that variable. So you would write down your formula, and then you would put BO, you would have 50,000 times 95% equals 47,500 equals PMT, and you would then have 50,000 times 14% divided by 4. So as long as you are correctly identifying or calculating the correct value for each known variable in the formula, you will get all of these marks. You'll only be missing out on these this final mark over here if you don't have a financial calculator, and if you're unable to solve for R manually using the maths. I just can't remember at the moment if they've got, where's our bonds? In the textbook. Yeah, there is a method in the textbook that you can use using the tables. So have a look at that. But obviously it's going to take you longer to do that. So always just bear in mind the amount of time that you've got. And if you have already correctly identified all the variables and you've run out of time, then just leave the question, leave some space and move on to the next one. And you can always come back to the question and try and finish off your maths for solving for the value for R if you've got time at the end. Anybody got any questions on this bond valuation, on the bond valuation question? Nothing yet. All right, so let's have a look at the next one. So then question 3 for 10 marks says, calculate the book value per share for Conversion Limited at the 31st of August 2019. So this is then going to be a learning unit 5 question, share valuations. So in learning unit 5, we have got 5 different methods that we can use to calculate the value of a share. We've got the dividend growth model. I should actually count that as 2 because the dividend growth model is either constant growth or variable growth model. 2 formulas. We used one of those, looked at one of those last week. You've got the free cash flow valuation model. You've got the price earnings valuation model. And then we've also got either the book value or the liquidation value model. So there's 5 different ways that we can calculate the value of a share in learning unit 5. So you need to know each of those 5 methods. So here they've said we've been provided with the following extracts from the statement of financial position of this company as at the 31st of August 2019. And using this, please calculate the book value per share. So take note, they want the per share value using this information. So we know that when we are using book value means from the actual books of the company, in other words, in our statement of financial position, as things are valued in our books, we are going to take those values. We'll make any adjustments to those values if anywhere in this information here they have said decrease inventory by 5% or decrease receivables by 10% or anything to that effect. This particular question, they've kept it simple. None of these, they haven't told us to adjust any of these values, so we are going to take them as is per the book. The one thing we need to remember is when we are taking book value of our non-current assets, if we've got goodwill in our statement of financial position, it would be listed under non-current assets. And they have told us that of our total non-current assets, goodwill accounts for 1/4 of the total value. The rule when we are calculating book value of a company is that we exclude goodwill from our valuation. And that is just a valuation rule. We don't include the goodwill in our value, in our book value of the company. Because it's basically considered, I guess you could kind of like say, a theoretical value that can't be backed up by anything. And so we exclude it. The mortgage loan is payable in full at the end of August 2021. So we can see that's in 2 years' time. So the reason they give us that information is so that we can correctly identify the mortgage loan as a non-current liability. Then we've got inventory, receivables, payables, and we need to identify those as being liabilities or assets, and those are all obviously going to be current. And then the total value of the share capital is 88,000 Rand. And the way we arrived at that 88,000 Rand is that we sold shares at a nominal value of 11 Rand per share. And our shares are currently trading on the JSE at only 4 Rand per share. So this is for 10 marks. So this is a nice, easy 10 marks. What you would do is make your list of each of these values that they've given us. We write it down with the correct valuation according to how we're going to calculate the book value. And you'll just take note over here in this list here, they have all of these values have just been given to us as a value. They haven't told us whether it is a liability or an asset. And we know that our book value is going to be assets minus liabilities equals equity. So non-current assets is positive 1,500. We need to subtract 1/4 of that value in order to deduct the goodwill. Then current assets will be added. You could have put them individually, receivables and inventory, 80,000 plus the 95,000. Non-current liabilities, the liability must be in brackets, must be deducted. That's our mortgage loan. And then current liabilities, that's our receivables, must also be a negative, equals the book value of 500,000. So you need to get your pluses and your minuses correct, assets and liabilities, so that you arrive at the correct book value. So this book value is a total 500,000 Rand for the total value of the equity. They've asked us to calculate a per share book value. So in order to be able to do that, we need to know how many shares has the company got, so that we can then divide this 500,000 by the total number of shares to arrive at an equity value per one share. So they told us that the book value of the current shares was 88,000 and that the nominal or par value of those shares was 11 Rand. So we always divide the book value, the book value of the share capital by the nominal value or par value of the shares to arrive at the number of shares that we sold in order to raise that 88,000 in the first place. We do not use the current price, because obviously the current price is constantly changing, and this 88,000 book value of share capital is going to remain constant in our statement of financial position. So 88,000 divided by 11 Rand, sorry, wrong one. Oh, sorry, guys, I hate it when it jumps around like this. 88,000 divided by 11, that means we have got 8,000 shares in issue. So 500,000 total equity value divided by 8,000 shares gives us a per share book value of 62.50 Rand. So again, you've just got to know all these little quirks to the questions. So in other words, to remember that goodwill is always deducted. Sometimes they will mention something to that effect. You need to remember that assets will be added, liabilities will be subtracted, and that the answer that we are going to get is going to be the total value of the equity, and that we must then divide that by the total number of shares in issue to arrive at a book value per share. Again, depending on how they asked us the question. Okay. Then for 15 marks, our question 4, and I think this is the last one. I want to just check from a time point of view. Yeah, question 4 is the last one. They have given us this information. Maximum Limited is a listed company, which our company is considering acquiring. So we are considering purchasing the entire company called Maximum Limited. In considering the acquisition, we've been asked to undertake various valuations and analyses of the business so that we can then make our decision. Remember, our whole job as a financial manager is to calculate, do all kinds of various calculations and analyses for the purpose of decision making. We've sourced the following financial information taken from the most recent set of financial statements for Maximum, as well as recent analyst reports. So this is the information that we have been able to gather about this company. So again, we've got an extract from the statement of financial position. The equity and liability section of the statement is equity, ordinary shares, total value of 900,000. Retained earnings, total value of 920,000, and preference share capital of 80,000. So that's what makes up the equity section of our balance sheet. And then non-current liabilities, we've got corporate bonds in issue for 425,000, and we've got bank loans outstanding of 875,000. Sorry, not we, the company that we are analyzing. Then the forecast, so this is for as at May 2019. Then forecast for the next 3 years, we've got after-tax profit, retained earnings and dividends. Okay, so profit after tax for the next 3 years, retained earnings for the next 3 years, and dividends. And take note, this would obviously be a total dividend payout for the next 3 years. Then included in profit after tax, so included in these values here, in other words, in calculating these values for profit after tax, we took into account depreciation and amortization of those values for each of the 3 years, and there was an interest expense of that amount in each of those 3 years as well. So we deducted depreciation, we deducted interest from our profit figure in order to arrive at this profit after tax amount. Other information that they've given us, the cost of equity is 15% and the weighted average cost of capital is 12%. Analysts have estimated the company's beta to be 0.75%. In other words, how does the company's risk compare to the market risk? And remember, market risk has got a beta of 1, and we'll then compare that to our specific company. The average industry PE ratio is 6. And for this specific company, we need to have an upward adjustment of 3 to that value of 6 to arrive at a price earnings ratio for this company for its specific risks. The carrying values of the corporate bonds and bank loans are considered to approximate their market value. So they're saying that these values here, 425 and 875, that's a fair value. We don't need to make any adjustments to that value. 30% of retained earnings will be reinvested in the business as funding for expansion in the future, and 40% of the annual depreciation charge will be used for asset replacement costs. So that is information telling us what rand value the company is going to spend on capital investment in the future. Analysts have forecast the dividend and earnings growth rate post 2022 to be 10% per annum. In other words, the future growth rate or terminal growth rate will be 10% because we have got a dividends 3 years worth of the most recent dividends here, which we can calculate use to calculate the immediate growth rate if we needed to do that. So lots of information that they've given us here, and you can see we can use this information that they've given us here for all sorts of calculations that we have already calculated. So first of all, just for 3 marks, they've said calculate the value of maximum using the price earnings valuation model. And they've said, hint, use 2020 as the basis for the calculation. So we know that the PE valuation model means we are just going to take the calculation that we use for the price earnings ratio, and we are going to solve for P, in other words, price. Remember, the P in the price earnings ratio stands for current market price of the share. So current market price of the share divided by EPS is equal to the PE ratio. So let's go and have a look at what our answer looks like for that. So I have written at the top here, so the PE ratio is equal to the current share price divided by the earnings per share. So therefore, if we are trying to calculate what the share price is, share valuation means what is the share price, so that we're solving for the P in the PE ratio. Share price would be equal to the PE ratio multiplied by the EPS or the earnings of the company. They said use 2020 information. So we've got profit after tax, 475,000, which would be the earnings. And they have told us here that The industry PE ratio is 6, and we must, for this company, increase that by 3. So here is our 475,000 earnings from 2020. Here is our PE ratio calculated. 6 plus 3 is 9. So we can now go PE ratio 9 times the earnings, 9 times 475, and that gives us a total value for the company of 4.275 million. Okay, so that's not a per share value. That is a total company value, because we have multiplied 9 times the total annual earnings, not multiplied by the earnings per share, which is information we didn't have. Okay. So note, because we want a company valuation, they didn't ask us in this question for a per share valuation. They said, what is the value for the company? That's why we have used the full earnings and not just the EPS. Okay, happy with that. Then our question 4.2 is a theory question. Where they said, advise the management board of any 2 reasons why you prefer not to use the dividend growth model to value companies. And remember, in your learning objective there for the dividend growth model, in your textbook, we've got advantages and disadvantages of the dividend growth model. So obviously we would go to the disadvantages of using the dividend growth model and choose 2 of those to give those as reasons why we would prefer not to use it. And then the last question is calculate the free cash flow of Maximum Limited, also for the year 2020 only. So again, as I reminded you last week on your formula sheet for free cash flow, there are 2 calculations. Just trying to find it in the textbook. In the old textbook, it was free cash flows on page 130 in the textbook. Not sure in the new textbook. But if you go to that section and example 5.4 in the textbook, free cash flow valuation model, you'll see that in example 5.4, the first table in example 5.4, they give us information about budgeted projections of a particular company. Quite similar to this information that we've got here about how much money are we going to spend on capital expenditure in the future, what is the rand value of our depreciation, what is the interest expense, etc. In example 5.4, the first table is similar information to what we've been given in this question. The second table in example 5.4 is the calculation for the free cash flow of the company. Only in example 5.6 do we then use the free cash flow valuation formula and calculate a value for the company. So I just want you to make sure you understand in free cash flow, there are 2 calculations that we can do. The first one is we can calculate the actual free cash flow. In other words, what rand value per annum does the company have that can be considered to be free cash? In other words, cash that is free to be reinvested or to be paid out to the shareholders, as opposed to the free cash flow valuation model, which actually then calculates a value for the company, similar to what we did in 4.1, where we used the PE valuation model to put a value on the company. Okay, so let's go and have a look at the free cash flow Actually, let me just also show you in the formula sheet. Here on the formula sheet is included the formula for the free cash flow. And take note, the formula says FCF, free cash flow. It does not say free cash flow valuation model, which, by the way, is not on the formula sheet. But if they were to ask you for the free cash flow valuation model, you would come to this formula here, which is on the formula sheet, variable growth model, and you would use this formula and just adapt it a little bit because it is almost identical to the free cash flow valuation model in the textbook. Okay, so this I'm just going to put here, similar to free cash flow valuation model, in case they asked you. But they only asked for the free cash flow, not for the free cash flow valuation. Okay. Can get confusing. That's why I'm just trying to break it down for you guys. Okay. So that was just a theory question. I'm not going to go over that. So here is our free cash flow. I've typed the formula. So this is the exact same formula that I've just showed you on the formula sheet. If we want to calculate, and that was also in example 5.4 in your textbooks, okay? To calculate the free cash flow, we need to take the EBIT for the particular year, and they told us to use, 2020. We multiply that by 1 minus T. So in other words, we take EBIT and we subtract tax from EBIT, because EBIT is earnings before interest and tax. So we take EBIT and we subtract the tax. We add back any depreciation, because remember, depreciation is, is a non-cash transaction. So we add that back. We also add back any after-tax interest charge that they told us about, because the free cash flow calculates the amount of free cash available after paying for our capital expenditure, the amount of free cash flow available for meeting any interest obligations and for paying out to shareholders. So because we want to know how much cash flow is available in total for paying out interest and to pay shareholders, that's why we are going to add back the interest charge that we already had, because we want the cash flow before paying out any interest. So we add back depreciation, we add back after-tax interest, then we subtract any net capital expenditure that we intend to make, and we also subtract any increase in working capital that we need to make in that particular year. Because remember, any increase in working capital is a direct cash flow reduction, and any money that we are going to spend on purchasing new capital equipment is also a direct cash outflow. So that's the principles on which we are using to calculate free cash flow. So again, we want EBIT. They gave us profit after tax, 475,000. So because that was already after tax, read carefully, we don't need to multiply that by 1 minus T, because that 475 is already after tax. So then we are going to add back depreciation. So for 2020, we're adding back the 190,000 from the table. We are going to add back interest. So we are going to add back the 40,000 interest they gave us on the table. This particular memo, I see that they have just added back the 40,000, but we should in effect add back 40,000 minus the 28 or 27% tax according to the formula. Then minus, oh sorry, I beg your pardon, they have here, they've done it separately. Okay, beg their pardon. Minus tax on interest, so 40,000 minus, in this question it was still 28% tax. So this here, 40 minus the 11,200 is this over here. It's 40,000 times 1 minus T. Then we want to subtract CapEx, or CapEx is capital expenditure. So in the question, they told us that we are going to spend 30% of our retained earnings on new investments and 40% of our depreciation expense on replacement investments. So we're taking our retained earnings times 30%, and this was for 2020. Our depreciation times 40%, add those two amounts together, and 143,500 is the projected spend on CapEx that we think we will make. So that must be subtracted from our profit after tax. So we've got profit after tax, add back the depreciation, add back interest after tax, subtract any capital expenditure we intend to make. They did not mention working capital, so there was no adjustment to be made for that. And the amount that's left over after that is then our free cash flow, 550,300 Rand. Okay. So you can see what we've done. We added back depreciation, which is really is a CapEx expense, and we deducted the amount of the actual cash that we expected to spend on CapEx in the following year. Okay, so just remember example 5.4 is the same as this question here. And also just remember that the free cash flow formula is not the same as the free cash flow valuation model, which you will find in example 5.6 in your textbook. Okay, guys, we have come to the end of our time, just made it. And also the end of the question paper. So I was hoping I would be able to work through all of the questions. So we've now gone through this entire question paper, half of it last week and the other half this week. So this is a really nice question paper to practice these 3 learning units that you guys have to do for your task 2. So hopefully this is going to help you prepare. Any questions, guys? Anybody got any questions that that you've got other than that? Melanie's not got any questions. Who else is still online? I think we lost our meter along the way. Diana, are you okay? No questions. Awesome. Okay. All right, guys. So don't forget this recording will be available to you. So you'll be able to come back and listen to last week and this week's recording. And also this question paper that we've been working through last week and this week, I have already uploaded the question paper with the solutions in your more resources. Okay, so the questions and solutions are in your more resources. So you can already go and access that to practice with as well. All right, so best of luck, guys. You will be submitting your task on Monday, this coming Monday. Double check that it is Monday. Oh, is it a Tuesday? Yeah, I'm just looking here. I see it's a Tuesday. I beg your pardon. Next Tuesday. Yes, thank you. I don't know what I think one of the other classes is doing it. Next Tuesday is task day. So I won't see you again before then, but I will see you next week, Wednesday. And then we can, if I've had time to look through the task, we can then maybe have a look at the task that you did, that you submitted the day before. Or if not, if I don't have the details, sometimes they only give us that information a day later. And if I don't have the solutions or anything yet when I see you next Wednesday, then we'll start working on our exam chapters. Okay, all the very, very best of luck. Hoping, crossing fingers for a really nice paper. And remember, I'm available for questions at any point in time between now and when you write. Thanks very much, guys, and I shall see you next week. Bye then. Bye.